Hi everyone, today we'll talk about how incentive stock options work when the strike price is the same as the fair market value. I'll walk you through the key points to understand what happens when you exercise these options and what to keep in mind for the future. Before you exercise your ISOs, the first thing to make sure of is that you have enough cash to buy the shares. For example, if you have 25,000 shares with a strike price of $2 per share, it will cost you around $50,000 to exercise those options. The good news here is that since the strike price and fair market value are equal, you don't owe any taxes when you buy the shares. Now, since the strike price is equal to the fair market value, there's no delta or difference between the two. That means you don't need to report anything on your upcoming tax return and no taxes are owed right now. Even though you don't owe taxes now, it's important to track two things for the future. First is the basis of your shares, which in this case is $2 per shares or $50,000 in total. Second is the date of purchase, because that will determine whether your sale is treated as short-term or long-term gain when you sell the shares in the future. When you eventually sell the shares, the gain or loss will need to be reported on Schedule D of your tax return. Whether it's considered short-term or long-term depends on how long you hold the shares. So if you sell the shares within a year, it will be taxed as short-term capital gains, which is generally taxed at a higher ordinary income rates. If you hold them for over a year, it will be taxed as long-term capital gains, which typically have lower rates. There are also some tax strategies you might want to consider, such as checking if your stock qualifies as qualified small business stock, which could exclude a portion of the gain from taxes, or looking into opportunity zones which allow you to defer taxes. Additionally, you might need to make estimated tax payments to avoid penalties. So when you sell the shares, you'll report the gain or loss on Schedule D of your tax return. Be sure to indicate whether it's long-term or short-term, depending on how long you held the stock. And if you qualify for any exclusions like qualified small business stock or have taken advantage of opportunity zone, that's the place to reflect those strategies. So to sum up, before you buy, make sure you have the cash to exercise the options. You won't owe taxes upfront if the strike price is equals to the fair market value. Track your basis and purchase date for when you sell later. When you sell, report the gain on your tax return and be aware of whether it's short-term or long-term for tax treatment. Don't forget to explore possible tax saving strategies like qualified small business stock or opportunity zones. So, thank you so much for your time and attention. I hope this has helped clarify incentive stock options work when the strike price is equal to the fair market value. Please don't hesitate to reach out if you have any more questions or need further assistance. That's all.